basically what we're seeing right now is actually reasonably good liquidity conditions in the world. The Federal Reserve in the US has had to address the debt ceiling, and as a result of that, the Treasury General Account, which is maybe sounding a slightly wonkish concept, but that's the bank balance that the US Treasury holds at the Fed, has been forced to run down to basically pay for US government spending in lieu of issuing lots of debt through this period, this interregnum. And as a result of that, a lot of money has flowed into financial markets. China's definitely adding a lot of liquidity to markets right now. They changed direction of policy very clearly, and they began to do that really late in 2024, but that's really carried through this year. So there's a lot of liquidity being issued by China.
Liquidity is once again becoming the most important variable in global macro. Over the past year, the financial world has been preoccupied with interest rates and inflation. But as we enter the second half of 2025, it's becoming clear that liquidity, not merely the cost of capital, is the dominant driver of asset prices. The concept of liquidity extends beyond traditional rate policy. It encompasses fiscal flows, balance sheet operations, FX reserves, bank lending, and central bank intervention. And across all these domains, liquidity is quietly rising. Michael Howell, CEO of Cross-Border Capital and a leading authority on global capital flows, has flagged a resurgence in systemic liquidity. According to his proprietary metrics, global liquidity bottomed months ago and is now expanding at pace, driven by a combination of U.S. Treasury cash spending, PBOC monetary easing, and reserve accumulation in Asia. Howell argues that this liquidity wave is not cyclical, but structural, rooted in fiscal dominance, rising debt loads, and geopolitical pressures that incentivize governments to ease, not tighten. He goes further, noting that China's policy shift is signaling a real devaluation of the yuan, especially versus gold, which acts as a signal asset for liquidity conditions. Raoul, macro strategist and founder of Real Vision, aligns with this thesis but focuses on crypto markets as the primary beneficiary. His analysis points to a high beta relationship between global M2 growth and digital assets, particularly Bitcoin and Ethereum. In his view, we are at the early stages of a powerful liquidity-driven cycle, what he calls the banana zone, where exponential returns emerge from reflexivity, narrative shifts, and retail re-entry. This video analyzes both frameworks, identifying the common themes and what they signal for digital assets over the coming quarters. The key question isn't whether the Fed cuts rates next month. It's whether global liquidity continues to expand and whether crypto remains positioned as the highest conviction trade on that trend. As we dive in, please take a moment to support the channel. Hit the like button, subscribe, and turn on post notifications so you never miss an update. Your engagement makes a huge difference and helps us continue bringing you high-quality crypto and market analysis. Thanks for your support. Now, let's get into it.
As you know, we look at global liquidity. That's really the main focus of our research. That was something that we began actually decades ago, right back at the end of the 80s when I was at Salomon Brothers. And that was really when world financial markets were beginning to open up and global liquidity was really the main driver. And it's sort of come back certainly into fashion in the last 5 to 10 years, particularly with, in the wake of the GFC and COVID and whatever. And now in many cases, market movements are all about global liquidity, particularly if you look at Bitcoin. So it's clearly a major issue to look at. I mean, basically what we're seeing right now is actually reasonably good liquidity conditions in the world. I mean, that's fair enough. That comes through from partly technical reasons. The Federal Reserve in the US has had to address the debt ceiling, and as a result of that, the Treasury General Account, which is maybe sounding a slightly wonkish concept, but that's the bank balance that the US Treasury holds at the Fed, has been forced to run down to basically pay for US government spending in lieu of issuing lots of debt through this period, this interregnum. And as a result of that, a lot of money has flowed into financial markets. So technically, there's a great deal of cash, certainly in dollar markets right now. That may actually explain why the dollar's been soft on top. I think that's a thought worth holding. On top of that, we've also got a more structural factor, which is, I would say, generally more positive. And that is what China is doing. China's definitely adding a lot of liquidity to markets right now. they changed direction of policy very clearly, and they began to do that really late in 2024, but that's really carried through this year. So there's a lot of liquidity being issued by China. And you can see that very much, I think, in what's happening to the gold market. The fact that the yuan gold price has rocketed is, I think, pretty much testimony to the fact that the Chinese want to devalue the yuan, certainly as a paper unit against real assets. And they're doing that through injecting lots of liquidity. The question mark I think one's got to have is what the Federal Reserve is planning to do in the second half of the year. And the reason that we're sort of pondering this and maybe slightly concerned is a lot of the rhetoric that's coming out of the Federal Reserve is all about still balance sheet shrinkage. They want to get reserves down, so they say. That's reserves of the banking system. And if you look at their plans are that the balance sheet will continue to shrink through end 2025. And that means actually reducing bank reserves quite noticeably if they're going to hit those goals. Now, I think it's fanciful for them to do that. I think it would be crazy, in fact, if they did take a lot of liquidity out, because it would basically end this bull market pretty abruptly. And I think that's basically the big concern. Now, what I want to do is to add a thought to that, and that is that maybe we're looking at the wrong vehicle when we're looking at the Federal Reserve. And maybe the Federal Reserve is actually deliberately wanting to pare down its balance sheet, because what it realizes is going on the other side is a lot of liquidity creation or proxy liquidity creation by the US Treasury. And that is coming really as a result of two things. One is that we know that the US deficit is blowing out and it's becoming more and more difficult to fund. And secondly, it's becoming particularly difficult to fund in a world where yields on long-dated coupon debt, in other words, government debt, are actually rising. And although I know the rhetoric that's come out of a lot of the media is that the US is finished, and the US extraordinary privilege or extraordinary the exceptional performance of the US is now over, well behind us, and people want to sort of hit on the dollar and hit on the treasury market. That's actually a fake narrative. If you look at the data, it's not that US yields are driving world yields up. It's actually that world government bond yields are driving US yields up. And that's really the paradox here. The US hasn't lost any of its safe haven status, as far as we can see looking at the data. What you're seeing is actually very clear rises in Japanese government bonds, JGBs. Yields are starting to soar there. And also in Europe, you've seen noticeable increases both in UK gilt yields and in German bund yields. The German bund yields have been going up really because the debt brake has been taken off back in March in Germany to afford a lot of this defense spending, which is likely to be an extra burden on European governments. So that's really the overview picture. Are we bullish? We're certainly bullish near term. I think there's money going into markets and there's a lot of liquidity around. As I say, I raise a question mark about dynamics through the rest of the year. But the question is does the Treasury undertake what may be called a sort of secretive easing through the bill market to try and get try and afford some of this debt? And the problem they've got is with yields rising globally, they're being forced into the short end of the market, and that's effectively proxy liquidity creation.
Michael Howell frames global liquidity as a function of base money creation, cross-border capital flows, and central bank balance sheets. According to his proprietary Global Liquidity Index, which aggregates over 80 data points from central banks, FX reserves, and shadow banking channels, liquidity bottomed in late 2023 and has since turned sharply higher. A key driver is the U.S. Treasury's drawdown of the Treasury General Account, TGA. Howell notes that since January 2024, the TGA has declined by over $500 billion, pushing equivalent reserves back into the banking system, effectively acting as a fiscal liquidity injection, even while the Fed maintains its QT program. Simultaneously, China's PBOC has increased liquidity through required reserve ratio cuts, direct lending programs, and an engineered depreciation of the yuan. Howell points out that while the nominal CNY per USD rate has only modestly shifted, the real devaluation, particularly versus gold, is more pronounced. Gold priced in yuan hit all-time highs earlier this year, signaling an implicit revaluation of hard assets relative to fiat. This strategy helps China reduce the real burden of local government debt while supporting the balance sheets of commodity producers, effectively exporting inflation through weaker currency dynamics. Raoul extends this framework to digital assets, citing a tight historical correlation between global M2 growth and crypto market cap. His GMI liquidity composite, which aggregates central bank net liquidity and fiscal flows, turned positive in Q1 2025, and crypto began outperforming risk assets shortly after. Powell estimates that Bitcoin and Ethereum are functioning as liquidity proxies, with a beta of 2 to 4x relative to global liquidity inflections. He projects that if current trends continue, particularly with the Fed expected to pivot by Q3 or Q4, the total crypto market cap could rise from $3.2 trillion to over $10 trillion by late 2026, with upside skew driven by institutional flows and sovereign adoption narratives. However, both analysts are clear-eyed about the risks. Howell warns that a resurgence in U.S. inflation or fiscal tightening could force the Fed to resume aggressive quantitative tightening or delay rate cuts, which would compress liquidity globally. Powell adds that volatility is inherent in transition periods, and that we should expect 20 to 30% drawdowns even within a secular bull phase driven by liquidity expansion.
China's a very different situation, and China needs a script by itself. The fact is that everybody is written off China, and they're saying China is mired in debt deflation, the banking system is bust, the financial system is going to fall apart, et cetera, et cetera. This is just sort of the narrative that we've currently got, which is very anti-China. I think the reality is that, as I've long said, the Chinese financial system is actually quite straightforward. What they need to do, beyond anything else, is to devalue debt, and they need to inject a lot of liquidity into the Chinese money markets. And that's really in the gift of the People's Bank, and it's a decision the People's Bank will have to make. And what I'm arguing is they're now making it. For a long time, they did not, because they wanted to hold the yuan stable against the US dollar. But actually now they seem to be more flexible on the currency. And in particular, what they seem to be doing is letting the currency devalue aggressively against the price of gold. Now, that's a story in itself, but I think it's a very big story, because what's happening is that China is reflating. And I think that reflation is starting to come through in terms of world activity. And what you're seeing is a very significant rebound going on in the world economy. Now, let me just evidence that. So I'm going to go back to these slides. So this is the picture for China. This is showing the People's Bank's net liquidity injections into the system as a rolling 6-month sum measured in terms of billions of yuan. And what you can see is that there's been a steady build-up. But let's contrast the picture now in, let's say, the first half of 2025 with what you saw through most of 2024. So through most of 2024, their liquidity injections were going down, and then they've basically turned. Bear in mind, this is a rolling 6 months, so it's really giving you the trend. And that data is seasonally adjusted, so it takes out things like the Lunar New Year and the great seasonality in Chinese money markets. But it's very clear that they're treading a new policy path. And what I think they're doing is they're trying to devalue the yuan. Now, this chart is illustrating the yuan gold price and the yuan US dollar cross. Now, the reason for showing the two together is that what I'm trying to do is to contrast the fortunes of the yuan dollar with the yuan gold price. The yuan dollar in black is shown on the right-hand scale, and that's been, generally speaking, quite stable, although you can see that it has generally drifted weaker over time. The Chinese have been trying to hold it down into a range of, let's say, around, for argument's sake, say 7.1, 7.3 against the US dollar, and it's basically beginning to weaken more through that level. Now, I don't think the yen dollar is really should be the focus, but everyone's looking at that. There's no way that the Chinese are uncompetitive against the US dollar. and it wouldn't do them very much good, I don't think, to actually devalue against the US unit. What they really want to do is to get out of their debt problem. And the way that they get out of their debt problem is to devalue the paper yuan against real assets. And if you hold that thought, reconsider gold as a real asset, which it is. And therefore, what they need to do principally is to devalue the paper yuan against the gold price, if gold is the proxy for all real assets. And you can see what's happened here since the beginning of 2022 is that the yuan gold price, which is now just about 23,000 or just over 23,000 yuan per ounce, has more than doubled over that time period. Now, we set out about 18 months ago a policy where we said if China is to get its debt back in order, in other words, it needs to get its debt to liquidity ratio, which is the key metric, not the debt to GDP ratio, which is a fake narrative that economists talk about. What you need to do is to get debt and liquidity back in line, because debt needs to be rolled over and refinanced, and you need liquidity for that. China's debt liquidity ratio, I should say, was about 30% above normal levels going into this crisis. That's why they had the crisis. And what they need to do is to expand the liquidity base by about 30%, which basically means adding huge amounts of liquidity to the system. In terms of what the yuan gold price needed to do, we figured that would mean at least a 26,000 per ounce yuan gold price, and we're well on that target. If you cross-reference that, looking at what that would mean in dollar terms, it would mean a dollar gold price of over $2,600 per ounce of gold, and I think we're on track for that. The gold price, as I say, that's the minimum target. Gold has got to go up further, but what you're seeing very clearly in the case of China is monetary inflation is being created. And monetary inflation is not just a Chinese phenomenon, it's becoming a global phenomenon, because more and more policymakers worldwide will have to address this problem, particularly as yields are rising in their bond markets, of how to fund their governments. And the only way they can do that is to monetize fiscal deficits, which basically means printing money. And this is what's going on right now.
Raoul Pal's framework draws a direct causal link between global liquidity cycles and the price behavior of crypto assets. According to Pal, the crypto market functions as a high beta liquidity proxy, meaning it reacts disproportionately to changes in global M2 growth, real yields, and central bank balance sheets. This makes digital assets not merely speculative instruments, but predictive signal amplifiers of broader macro shifts. In his recent analysis, Pal highlights that global liquidity, measured as the aggregate balance sheets of major central banks and global M2, has begun to rise once again. He attributes this not to a single monetary policy decision, but to a convergence of structural forces: U.S. Treasury drawdowns, Chinese monetary easing through RRR cuts and yuan depreciation, and potential BOJ intervention as the yen weakens. He argues that this multipolar injection of capital is creating the ideal conditions for reflexive price behavior, particularly in crypto markets. Pal's model identifies a repeating 4-year cycle in crypto, roughly aligning with Bitcoin's halving schedule, but more tightly correlated with global liquidity inflections. He asserts that we are now transitioning into the banana zone, a term he uses to describe the exponential phase of the cycle when price gains become nonlinear. This stage is characterized by high-velocity capital flows, increased institutional engagement, and aggressive repricing of scarce digital assets. More specifically, Pal notes that Ethereum is tracking its prior cycle almost identically, with a near 95% correlation to its 2019 to 2021 trajectory. Bitcoin, while slightly less correlated, is also exhibiting behavior consistent with the early stages of a parabolic advance. He also observes rising open interest and positive funding rates across crypto derivatives markets, signs of growing speculative positioning. Looking forward, Pal estimates that digital assets could command up to 10% of global assets under management over the next decade, up from just over 1% today. That implies a 30 times expansion in the crypto market cap, from roughly $3 trillion today to over $100 trillion, assuming no major structural disruptions. He positions this growth not just as a retail phenomenon, but as a macroeconomic inevitability tied to demographic shifts, the digitization of finance, and a long-term decline in trust in traditional fiat systems. In his words, crypto is no longer a sideshow. It's becoming the core expression of global liquidity excess. For informed investors, Powell argues, ignoring this space could mean missing the largest asymmetric opportunity of the decade. But he also warns that volatility, regulation, and monetary policy whiplash remain critical variables, and that portfolio sizing must account for both convexity and risk. Ultimately, both Howell and Powell converge on the idea that the next leg of the macro cycle is being written not in headlines or FOMC speeches, but in the undercurrents of liquidity flows, and crypto markets may be the most sensitive instrument we have to track its rhythm. Do you see liquidity and financial conditions as the primary drivers of the crypto market, or are there other factors you think are more significant? Please share your thoughts and observations in the comments section below. Your feedback can help us build a more nuanced discussion and share different perspectives with the community. Thanks for watching.